of the branch and CAJ Venkateswar sir, past chair, Central Council member and today's speaker for the program, and all the members who are attending this program. Now I invite Satish Kumar Mailavar, Vice Chairman of the branch, to give overview of the program and welcome address.
Yeah, thank you, Ravi Garu. Good evening and welcome everyone. Respected past Central Council member from our southern region, CAJ Venkateswar sir. Welcome, sir. We fondly call as JV sir. Sir, we are really happy and privileged to you for accepting our request to address us at the need of the hour. Members, we all know the importance of our ICA Code of Ethics, which we should follow in our day-to-day practice in all aspects, which one by end of the day guide and monitor all our activities of the members. We all might have had some recent incidents too, which actually warn all of us to be more cautious before signing any document or giving any certification works, etc. Today, we thought of and we requested CAJV sir to enlighten us on this topic, and also requested sir to give some practical case studies so as to understand to take care of all our members in their works. With this small topic introduction, I request CAJV sir to take forward the session, please.
Very good evening, Vice Chairman, Secretary, and in absentia, the Chairperson and other Managing Committee members of the branch, and the delegates who have enrolled and joined for the program. A very pleasant good evening to each one of you. And I'm thankful to the Hyderabad branch for inviting me to share some of my thoughts on the disciplinary mechanism and the code of ethics, which is always an evergreen subject for all of us, whether we are in practice or in service, because we are always, so long as you are a member of the institute, we are expected to be governed by the code of ethics and code of conduct as stipulated in our schedules. And it's time that the Hyderabad branch has been conducting a program on this code of ethics, at least one or two in the last 3 years. This is the third lecture I am speaking. So I am also remembering the importance of the given by the branch for this program. And thanks for choosing me again as a speaker. I hope I am able to deliver the content, or rather you are trying to tell me that till you are satisfied, I should keep on addressing on this matter. So I take it the other way, that not many speakers are coming forward to speak on such a dry topic. And with a huge experience behind me, as I was in the disciplinary committee for 5 years in the 9 years of my council tenure, and further 3 years as a member of the appellate authority, which I have just demitted the office 2 months back on 28th February. So with all that little experience, whatever I have gained in the disciplinary mechanism, I'll try to address on some of the most frequently violated or non-complied clauses of the Code of Ethics, the first and second schedules of our CA Act, because I will not be taking you through all the volumes of the Code of Ethics. So now we have 3 volumes, and even 2 schedules also. I will not be taking through all the 2 schedules, because in the given 2 hours time, we can't do justice for the entire subject. So what I did, I picked up some clauses where many of the members are either non-complying or not able to fully comply, and therefore getting the complaints against them. And also some cases which were in my knowledge during my tenure in the council or subsequently reported. Of course, now the case laws are available in volume 3 of the Code of Ethics. Members can definitely read it. But whatever I remember and which are useful to us, I think I'll try to recall some of my memory and speak to all of you, so that you can pick up some points and avoid doing similar mistakes and avoid getting any complaints. So I'll start my screen sharing. I hope the screen sharing facility has been given to me.
Yes, sir, it is there, sir.
Yeah, it is now available.
Appearing, sir.
Yeah. I think I should. One second.
ఈ side close చేసేయండి.
Yeah, is it now?
Yeah, perfect, sir.
Fully
Yeah, full
visible?
single side, full screen.
Sir, it's full screen, sir.
Yeah. Right. So as I said, I'm going to talk today on practical case studies and some important clauses of first and second schedules to the CA Act 1949. Firstly, why a code of ethics at all? What is that code of ethics and why at all we need this code of ethics? See, code of ethics is essentially for commanding the respect and confidence of the regulators and public at large, because we as a professionals should have a proper respect and command at the regulators and the public at large. Therefore, we need to have a set of our own rules and regulations so that we enjoy the respect in the society. So the conduct of our members is regulated under our own act and the regulations framed thereunder. And what is all about this code? Essentially, it is a set of professional ethical principles and standards regulating the relationship of chartered accountants with the clients, employers, and employees, and fellow members of the group and the general public at large. So this code of ethics actually is contained in our first and second schedule, do's and don'ts for the chartered accountants. And now the institute has brought out a separate volume 1 where our independence and integrity have been highlighted and the risks and threats that are likely to arise during the course of our professional work are also highlighted. So this is all a set of principles and standards which regulate our profession and relationship with our co-CAs, clients, employers, employees, and including our students also. See, the code of ethics is there right from 1963 when the institute has published for the first time. Those days it was just a commentary on the clauses of first and second schedules to the CA Act 1949. But subsequently, the code has been amended and modified over 12 times. The last thorough revision was made in the year 1920 when the institute has released 3 volumes of the Code of Ethics, which is essentially based on the International Ethical Standards Board's code. So now we are on par with the International Ethical Standards Board, excepting for certain clauses which have been deferred because of the COVID. And the institute will announce notify those classes which have been deferred for implementation. These clauses, again, I am not going to deal with all those clauses, but I can tell you 2-3 clauses which have been important and deferred. That is one, no clause, that is non-compliance with regulations or laws, applicable laws, which is whenever the client is not complying with such clauses, the applicable laws, it is the responsibility of the auditor to escalate and report it to the higher ups in the ladder. So, of course, it is there in our Companies Act under Section 143(12), where wherever there is a fraud, we are expected to report certain times to the board, certain times to the government, depending on the quantum and value of the fraud that is involved. So, similar cases have been brought into the Code of Ethics. It is not only the Companies Act, but even under any law, if the auditee is violating the code or doing anything wrong, we are expected to report. And another thing is the public entity concept. Like that, one more is the combination of fee received from a single client. If it is more than certain percentage of our gross receipts, we are expected to address our independence and showcase to the client that despite getting a huge amount of fee or a certain in excess of certain percentage of the fee, we are expected to maintain our standard independence. So all these things, these 3-4 clauses have been deferred for implementation, and they will be brought back or notified in the due course when maybe at the institute's time. Then the Code of Ethics also encompasses certain domestic laws apart from the CA Act. These are listed mainly, the Code of Ethics, you will see the compliance with accounting and auditing standards, and the guidance notes and other documents issued by ICI. Institute has been issuing various guidance notes, circulars, and technical guides, apart from the accounting and auditing standards. And all of them it's mandatory for the members, excepting where the same have been excluded. Otherwise, all of them are mandatory for the members. So therefore, all of them would apply as a kind of a code of ethics and compliance with the applicable laws to the auditee. That is, the Companies Act, the Income Tax Act, the Banking Regulation Act, etc. Wherever the laws are applicable to the auditee, and we are also expected to comply with the same as we are signing the financial statements of the client. So apart from the CA Act, these both guidance notes and standards on auditing and accounting and the applicable law to the the client, they are all applicable to us also, and we are expected to comply with them. Any non-compliance with any of them would lead to a kind of a misconduct, and ultimately it is a case where we will be held responsible for not complying with the applicable law and code. The misconduct under the CA Act has been defined in Chapter 5, that is our Act 1949, there where the title is Omissions and Commissions and Unethical Practices, which are defined also. The professional or other misconduct, as defined in Section 22 of the Act, is that the expression professional or other misconduct shall be deemed to include any act or omission provided in any of the schedules, but nothing in this section shall be construed to limit or abridge in any way the power conferred on the director. So it means not only the Schedule 1 and Schedule 2 listed clauses of offense or misconduct, but even any other misconduct also, even other misconduct also, the director discipline is empowered to consider it as a misconduct and inquire into the conduct of our member under any other circumstances. So therefore, do not go by the principles that only Schedule 1 and Schedule 2 are applicable to us. Beyond that also, we can be held responsible for failure to comply with the the code of ethics. So therefore, one has to keep in mind that even other misconduct also is liable for holding the member guilty. The commonly observed reasons or causes for filing the complaint against the members, because as I said, I have seen maybe more than 2,000 cases while I was in the council and outside the council, or 2,000 complaints against various members across the country. And I have tried to list out what are the generally observed mistakes or situations or reasons why the complaints have been filed against the members. When I tried to summarize them, I found that first thing is omissions and commissions noted in the audit reports or certificates issued by our members. Generally, some of the members might miss it to include certain things in the audit reports or commissions in the audit reports or certificates that we are issuing. So this would lead for the reader or for the client or for the regulator to file a complaint against the member for failure to report the correct requirements. The second area where complaints are coming is material mistakes or incorrect information in the measurement, presentation or disclosure of financial statements. Though you are all aware that the financial statements are prepared by the management, since we are signing them under our report, the material mistakes or incorrect information, whatever is there in the both measurement principles or presentation or disclosure of financial statements, we are also held responsible for such mistakes or incorrect information. This is another way where many of the members are getting complaints raised by various institutions or banks, or sometimes even the company people also raise when things are not going well with the auditors. The third area or reason is non-compliance with accounting standards and auditing standards, because we are all familiar, as I said, all the accounting standards and auditing standards are mandatory for all of us. And in every case where it is mandatory, we are expected to comply with it or qualify wherever required. Particularly the auditing standards, we deal at a later time. Whenever there is a situation where we need to qualify the auditing standards, we need to look at appropriately to word the qualifications or to make the modified opinion correctly, either under adverse opinion or disclaimer or qualified opinion. All these things have to be carefully seen, because in many of the cases, the auditors leave the matters or qualifications sometimes as the matters of emphasis, because the emphasis matter paragraph is only a making the reader to look into the observations made by the client in the notes on accounts. So if it is a qualification item, he has to report it as a qualified opinion. If it is a disclaimer, he should bring it under that head. So many of the times, the auditing standard non-compliance with auditing standards triggers the filing of a complaint. Same way, accounting standards also, because accounting standards now, we are all aware that both under the Companies Act, 2 sets of accounting standards are there, and 1 set again institute standards which are applicable for the non-corporate entities are there. So we need to be very careful in complying with the accounting standards and making disclosures, appropriate disclosures as required under the standards. Any deviation might lead for someone to file a complaint against the member concerned. Then the next area where complaints are coming is non-compliance with other applicable laws. Like, for example, for the banks which are already registered under the Companies Act, are also registered under the Banking Regulation Act. And in fact, the formats of the banks are prepared as applicable as defined in the Banking Regulation Act, Schedule 3 there also. Likewise, for the cooperative societies, it has to be prepared as per the requirements of the Cooperative Societies Act. And even certain disclosures of MSMED Act, you are all aware that it has to be given in the Companies Act. Why I brought this MSMED here is, in a recent case where a member was held guilty, was that he did not disclose the MSMED details in the financial statements of the company where he signed them under his report. The creditor who was affected went to the institute and filed a complaint saying that the member has not disclosed the MSMED details properly, therefore he was held guilty. So therefore it is in another case where I have come across a bank which was a regional rural bank has complied with only certain areas of the Companies Act balance sheet, whereas actually in the notes to statements of notes on accounts, they have, in the significant accounting policies, they have clearly said that they have also complied with Companies Act provisions wherever applicable. So in all those cases, the auditors are likely to be held guilty for not complying the things. Further area where the complaints are coming is FRRB findings. Many of you are aware that the Institute Council has a subcommittee called Financial Review Reporting Board, which sumo to undertakes annually to review certain balance sheets of the financial statements. There is a mechanism where the Institute picks up at random about 100 cases in a year, mostly big cases, comprising of all sectors, manufacturing, trading, banking, every sector, they pick up certain cases and then get them cold reviewed by our own chartered accountants. And then it has a 3-layer process. First, a reviewer will review, then his report will be reviewed by a group, and thereafter finally by the FRRB, that is at the council level. And wherever this FRRB finally confirms certain mistakes or omissions and commissions in the annual reports or in the auditors report, then they may refer, if they are serious, the committee may refer the matter to the disciplinary committee, and disciplinary committee will initiate it as an information case and pursue it as a complaint. So one has to be careful while finalizing our balance sheets itself, because this is a completely unknown source. Because in fact, when I was in the council, one of my clients' balance sheet was also picked up, and I got finally an advisory. Luckily, it was not a reference to the disciplinary case, so it was a referral advisory matter. So anybody may be picked up, including all big companies or small companies. So it all depends on how the institute picks up these cases. Then another channel of getting complaints is regulators like IT department. They have filed number of cases against the auditors for mistakes in tax audit and other reports which are issued under the IT Act. The ROC has been filing regularly on the technical scrutiny of the balance sheets or for mistakes in signing the DIR 12 or other wherever we are affixing our digital signature. In many of the cases, ROCs have been in fact directed by their ministry to file cases against the members before the institute for any mistakes on their part. SEBI also used to file number of cases against the matters where our members are involved in the listed companies or listing arrangements or whatever areas falling under their jurisdiction. Banks, of course, concurrent audit or other banks, wherever, even in cases of NPAs where the banks find that the auditor has a role in issuing the certificates, etc., at the time of sanction or at a later date. Banks also have been filing many cases, and particularly the branches which are under concurrent audit, there are large number of complaints coming against the negligence of our members. So members who are doing concurrent audits should be very, very careful not to miss out anything in reporting. Because I have also seen, and many of the members don't attend to these concurrent audits seriously. They depute their juniors or students, and finally the frauds take place, and then the auditors are called upon to explain why the frauds were not reported. And in several cases, the members were held guilty. Then RBI keeps filing complaints against the members, particularly again for their things that both under NBFC sector or in banking sector also, because particularly in NBFC sector we have seen many cases coming against the members because our members are not complying with all the requirements of NBFCs. SFIO is again the body of the Ministry of Corporate Affairs, which has been filing in most of the corporate fraud cases. They are also after us, holding us responsible immediately after the management. We are almost the number 2 in the accused list after the management and board of directors in all the fraud cases wherever it is there. CBI also, apart from criminal action, they are also filing complaints before the institute for the possible misconduct under the Chartered Accountants Act. ED, again, Enforcement Directorate also has been filing certain cases against our members wherever they find that our members are involved in the fraudulent activities made by the managements, or even professional negligence for not reporting things appropriately. GST department, I think it is fresh in our memory. 2 of our members were held in Delhi and arrested and all these things. GST department, it's not a new thing. Even under the old customs and central excise matters also, there used to be regularly complaints from the department against the members for certifying various things, forms and input credits or duties, drawbacks, etc., where our members were found to be not reporting correctly, so therefore were held guilty. Cooperative Audit Department also, wherever we do audits of the cooperative societies, it is there across the country, and all the registers of cooperative societies also review, like C&AG reviews the government PSUs. They also review our reports and then keep filing certain complaints if there are any mistakes. The disputes among the partners or directors of the auditee also causing a lot of concern among us, because many of the times these partnership firms or directors of companies, they get into disputes among themselves and then pull the auditor into the disciplinary mechanism, because we, in a small entities like a partnership firms, we may not be taking all kinds of documentation, etc. And they use that to settle their scores. They are filing against the Chartered Accountants complaints, and it has become a very common feature wherever there are partners. I'll deal some of the cases when we go into the subsequently. And disputes among the partners of the professional firms. I've also come across some of the cases of disputes among the partners of our own professional firms, where they have reached the institute lodging complaints against the other partners for the ethical matters or for the disputes between them. Though the institute is not a civil court for settling their things, but if it amounts to anything, as an other misconduct, etc., institute holds the member concerned guilty under the other misconduct, or if it is a professional misconduct. But if it is a civil matter, the institute would say you settle the matter between among themselves through a court. Then the last area where I find most of the complaints coming is other misconduct alleged by aggrieved parties. Suppose this other misconduct encompasses everything. If you do any other crime which is totally not related to the profession, also you may be caught and booked under this other misconduct. So some of the members have given some TV interviews explaining how they can convert the black money into white, etc. And some members have written books on how to convert black money into white, etc. All those cases, they come under this other misconduct. And even some of the family members also filed complaints against the members, alleging misconduct by the members in sharing of their properties or in their personal family matters, etc. So all these matters would come as other misconduct. So broadly, these are the sources or reasons for complaints coming against our membership at large. So we need to be careful to handle all these the respective areas where we are signing the balance sheet, or where while dealing with the partners of the client, or client within the partnership firms. In all these areas, we need to be extra careful so that we will not get unnecessary complaints. So the mainly the code of ethics is contained in the part 1 and part 2 of the first and second schedules of the the first and second schedules to the Chartered Accountants Act. So the first schedule deals with most of the matters, professional misconduct in relation to the CAs with the society and the colleagues, and in getting the work, etc. The second schedule talks of our misconduct while executing our professional works. So in the first schedule again has 4 parts, and part 1 is applicable for members who are in practice. So again in part 1 there are 11 clauses, 11 or 12 clauses, which I'm not going to deal all these clauses. I have only picked up some 5 or 6 clauses where generally the members are held, when complaints are coming, and members are held guilty. So the first part deals with in all 12 clauses. Out of this, I have picked up some 5 or 6. So a professional misconduct in relation to CAs in practice, a chartered accountant in practice shall be deemed to be guilty of professional misconduct if he, clause 2, I am taking up clause 2, pays or allows or agrees to pay or allow directly or indirectly any share, commission or brokerage in the fee or profits of his professional business. That is, if a chartered accountant agree to pay or allow or agrees to pay or allow directly or indirectly his share of fee with any non-CA, then he will be held guilty of professional misconduct. Of course, there are certain exceptions for this. I know members may ask, what about the multidisciplinary firms, which is been made permissible under our respective acts, though the acts have been amended, where we can join hands with other designated professionals like the company secretaries, cost accountants, lawyers, etc. But the necessary rules have not been framed by the respective institutes, and it is still in cold storage. So as of now, we cannot join hands with any of the other professionals, though the act is enabled to allow us to share the fee with others. So that is there on the statute book, but otherwise we are not entitled. And in certain states where certain fee received by us for auditing the cooperative societies have to be paid to the Register of Cooperative Societies towards their administrative costs. So that is permitted. That is one area where you can share. And the third area where we can share is a legal representative of a partner, say a widow, who is entitled for share of profit and goodwill when the partnership deed permits. In fact, today a very senior member called me and asked on this particular point whether the deceased partner's wife is entitled for a share in the firm. Yes, she will be entitled provided it is provided in the deed of partnership of that particular firm. If the deed is not providing for such sharing a partner by the successor or widower of the deceased member, definitely she cannot claim, and it may not be permitted also. So therefore, those of you who are interested can make a provision in the partnership deed that in case of the death of any partner, his relatives or his successors or relatives should be allowed to receive some portion of or whatever you would like to say, some amount are eligible. In a deserving cases, definitely I think it is a welcome measure, so that those dependents can get some money from the firm for some time at least. So all those riders you can keep in the deed of partnership, so that it will not, they will not become a lifetime partners for the remaining partners, maybe for 5 years or 10 years or amount, certain amount, etc. In all those cases are permitted for sharing. Otherwise, we cannot share our the fee with any of the other professionals. Then I move to clause 5, where securing of work through the services of person who is not an employee of such CA or who is not his partner by means which are not open to a CA, any professional business. That is, while we secure our work, we cannot secure it excepting through the services of our own employees or such other chartered accountants. That is, we can approach a chartered accountant for work, or we can, some of our employees can seek some works that is permitted, but we need to be very careful to see that clause 6 and 7 of the same part 1 of first schedule are not non-complied while securing the work, because the clause 6 and 7 deals with advertisement, securing of work, all those things. So one has to be careful while seeking work from others. Under this clause, definitely we can even seek work from fellow chartered accountants, seniors or juniors or whomever it is. But from others also we can seek, that is responding to tenders, all those things. But we need to be careful to follow the institute guidelines while responding to the tenders, because there are certain guidelines issued by the institute on responding to the tenders, advertisements, all those things. So one has to be careful while selecting and while seeking the work from other sources which are not open to us by way of advertising, etc. Then clause 8. Clause 8 is a very important clause where till about a few years back, at least 50% of the complaints used to be under this clause, because many of the times this clause says that while you are accepting the position of an auditor previously held by another CA, you have to write to the previous auditor asking him whether he has any professional objection for your accepting the assignment or audit. This is applicable for attest functions only, not for tax work or other non-attest functions. And this is applicable for all the types of audits that we are doing, like all types of audits, concurrent audits, bank audits, public sector audits, even a partnership firm, tax audits, everything, including it is applicable for bank statutory branch audits. But many of the times our members are not communicating with the previous auditors. But please make sure that to communicate with the previous auditor, at least by an email, or I'll come back to that point. If you are accepting it without having much time to communicate with the previous auditor, in the acceptance letter you can put a condition that subject to getting clearance from my the previous auditor, I'm accepting this. So therefore it is your responsibility first to write to the previous auditor. Whether he gives a NOC or not also is not so material, but you have to communicate with him. So as I said, this communication is required for all types of audits, and grounds for non-acceptance of audit to be stated clearly. That is, in case if the outgoing auditor is not giving you acceptance for your accepting the audit, so he should say that what are the reasons why he is suggesting you not to accept the audit. And non-compliance with 139 and 140 of the Companies Act, read with clause 9. Clause 9 will come little later. Clause 9 talks of accepting a position from the accepting the position in the place of outgoing auditor by way of a fresh appointment, or in other words, the old section 225 of the 1956 Act, where you have to follow certain procedure for removal of the auditor, or for appointing someone else in the place of the new auditor. So those conditions have to be fulfilled, and you have to carefully ensure that the company has complied with the current section 140 or earlier section 225 before accepting. Non-payment of undisputed audit fee by auditee other than a sick unit. Again, this is a valid reason for the outgoing auditor to reject or to say that you should not accept the audit. So while writing to the previous auditor seeking his NOC, you should also make a mention that whether any undisputed audit fee is payable by the client to the outgoing auditor. So that is a point you need to make it. So that is a specific request. You should make it in that letter, and that is again restricted to only the audit fees, not for any professional or consultancy fees. Only if the undisputed audit fee is not paid, the outgoing auditor can say that his undisputed audit fee is pending, but not for other professional services fees, if any, payable. Then, of course, sick unit, there is an exemption that even if it is not paid, then you can, he doesn't have a say to object for your accepting that. Then fees pending due to non-availability of previous auditor. In the current code of ethics, there is they have dealt with this subject, where the fee could not be paid because of non-availability of the previous auditor. In such cases, you need not worry. If it is not paid also, you can still accept. Then course of action in case of change of auditor, that is all that rules and regulations of section 140 and earlier Act 225 have to be complied with. Duty of retiring auditor to respond with correct information. That there is a now duty is also cast on the retiring auditor. Whenever he receives a letter from the new incoming auditor, it is his duty to correctly state the facts and with the correct information. And the incoming auditor can act after waiting for a reasonable time for reply. That is, the incoming, as an incoming auditor, you have written to the previous auditor, but he did not respond. You can probably send a reminder or wait for maybe a reasonable time and start your work without waiting for his NOC. And the mode of communicating is very important. As of now, the positive evidence of delivery is very, very important. It should be by way of a RPAD, that is registered post with acknowledgement due, and it cannot be by way of a certificate of posting, etc., or a personal delivery under acknowledgement, or from a mail retiring auditor's mail ID, official mail ID, or the institute is contemplating to use the UDIN portal also. It is yet to come into place. But otherwise, as of now, RPAD or personal delivery are very, very important, and you should take a personal acknowledgement if you are handing over it personally, or RPAD. And certificate of posting, of course, it is, I think now it is not there in the postal services. So earlier it used to be there. Number of cases they used to create this certificate of posting, which is not a conclusive proof of a communication. The institute never used to accept such kind of a communication. And then premises found locked, new guidance is available. That is, if the outgoing auditor's premises is found locked, then the incoming auditor can take that plea. But again, there is a guidance available on that. So we need to be careful whether it was really locked or it was just returned, etc. Then form not found at the registered address, new guidance is available. And in the case of special audit under IT Act or other acts where you are appointed for the first time, the Institute Code of Ethics suggests that it is a healthy practice to communicate with the statutory auditor of that client, though it is not a mandatory requirement. But the Institute advises us to make a mention or communicate to the statutory auditor, so that if he has anything to say on this particular client, he would come back to you. And communication in case of assignments by other professionals, again, it is a healthy practice. That is, suppose if you are accepting the internal audit of a company where it was done by earlier non-CA or by a cost accountant or by someone else, it is again a healthy practice to communicate with him. Though again, it's not mandatory, but it is a healthy practice. And as I said, in case of lack of time in accepting the government audits or bank audits, particularly bank branch audits, they send us a mail and they immediately call us also seeking the acknowledgement. So it is better you make it clear in the acceptance that it is subject to professional objections, if any, from the previous auditor. Because in some of the banks, I know in the case of concurrent audits also, though it was the bank which has picked up the new auditors on completion of 3 years, some of our members filed a complaint against the incoming auditor saying that he has not communicated to them. So in all cases, whether bank picks you through online or you have applied and they have given you the audit, it is always in your interest that you communicate with the previous auditor whether he has any professional objections for accepting the assignment. So under clause 8 is, as I said earlier, till about 15-20 years back, almost 50% of the complaints used to be under this clause 8. And in those days, people used to create, to cover up the matter, the communication through postal, that certificate of posting, all those things. So now, of course, I think it has come down, but I'm still getting some of the references from some of our friends asking for help in these matters. So it is always safe for you to first write to the previous auditor and keep evidence of delivering that letter. Even if he doesn't respond, it's not your lookout. For a reasonable time, you can wait and close. But in many of the cases, what I have seen, that our members on the last day, September 29th or September 28th, they accept a new assignment and write a letter and issue the report on 29th or 30th. So that kind of situations, please avoid, because client might rush to you on the last day, last hour, but nobody can help you if you don't communicate with the previous auditor and get a NOC. So in such situations, even the institute is, the disciplinary committee, BOD, are pointing out, how can you do the audit in less than 1 day or 1 hour's time? So all these things are questionable. So better you always keep it a mandatory requirement that whenever you are accepting the audit of even a society, charitable trust, all those things also have this requirement. And I know some of our friends landed in troubles while accepting the audit of charitable institutions also, or cooperative societies, or concurrent audits, or public sector audits, all these things, because it is a mandatory requirement and we have no other way except to communicate with the previous auditor and keep evidence of communicating, and then do the audit in a reasonable time. So don't communicate on September 30th and close it on same day by issuing the report. This is how generally the mistakes are happening, and that gives a clear evidence that the audit was not done appropriately with all the evidences, etc. So clause 8 is a very, very important thing. And while sending the letter, you make it into 2 parts. One, whether he has any professional objections for accepting the assignment. The second part, whether any undisputed audit fee is payable to the outgoing auditor. These 2 aspects should be there in your letter, and ensure that it is delivered in person or through registered post acknowledgement with sufficient time for you to conduct the audit. Then now we move on to section clause 9 of the first schedule part 1, which says that accepting an appointment as auditor of a company without first ascertaining from it whether the requirements of old section 225 of the Companies Act 56 or the new Act 140 of 2013 Act in respect of such appointment have been duly complied with. Because this section is also important, and in many cases it came against the respondents, where the respondent has not proved that he has verified the compliance by the company of section 225 or section 140. Of course, now under the new act, we are all appointed for 5 years. And in between 5 years, if the company wish to retire an auditor or ask him to send him out, then there is a big process. The company has to approach the government of India and for removal of auditor, all those things. Of course, the auditor can also resign, but even ROC checking, whenever we send a resignation letter, he is checking by way of sending a letter, because these forms are not taken directly. they seek the reasons, because I have a first-hand experience when I sent a resignation for a company about 3-4 years back. I got a call from SEBI, which was a listed company, after 3 years, checking why I have resigned, what was the reason, and all those things. So therefore, it is in our own interest that you need to be careful while resigning or when the company is trying to retire you. So this clause 9 requires the procedural requirements to be diligently adhered to. That is issuing of a special notice and then a response of the outgoing auditor that has to be circulated to the shareholders, and the shareholders have to consider that and still pass the resolution. And all those things, even notice to the retiring auditor should be sent by RPAD, and replies received from the retiring auditor are sent to all the members of. These all procedural requirements under old 225 or under current 140. All these things, the incoming auditor have to ensure that the requirements have been met by complied by the company. Though it is the company's job, as an incoming auditor, you should ensure that the section has been fully complied, and you should collect the evidences also. Because if you don't collect, or if you don't just rely on the verbal assurance given by the company secretary or managing director of the company that section 140 has been complied, then you will be in trouble. So the institute expects you to collect the evidences from the company about its compliance with section 140, so that there is no problem. So section 140 is verification with the company, this clause 9. Simultaneously, clause 8 also operates, because you have to communicate with the previous auditor, and if he has any objections, that also is parallelly both section clause 8 and clause 9 both operates. So it is to be carefully followed. And in the case of companies, I know some cases where the outgoing auditors, the incoming auditors have not sought the communication, they have not returned to the communication or not complied with section 140, where the outgoing auditors went and knocked the doors of NCLT. NCLT has passed orders saying that yes, the outgoing auditor's removal is incorrect, and the incoming auditors have taken all kinds of troubles to overcome those matters. Simultaneously, some of them have written to the institute also about non-communication or non-compliance with section 225. So all these things should be avoided as much as possible, so that you will not get into the trouble of facing any complaints. Then we move on to clause 11 of part 1, which says that a member engaging in any business or occupation other than the profession of chartered accountancy, unless permitted by the council so to engage, will be held guilty of professional misconduct, because we are expected to be full-time in profession or such other permitted activities by the council so to engage. We have regulation 190A, which under which the institute has generally permitted us to be some kind of things like tutor, author of books, or speaking at the tuitions or lectures, and even simpliciter, director, etc. All these things are permissible without any application. But if you wish to get into a business which requires your substantial time, or which amounts to a business, carrying on a business, suppose if you wish to accept the MD of a company, then you need to write to the institute and take the specific permission, where the institute will consider the time spent by you vis-a-vis your professional requirements, and then they may say that part-time certificate will be allowed to you. So that is that has to be kept in mind while undertaking any other business. Even if you hold a second qualification like ACS or a cost accountant, you cannot be practicing under both the things. That is, of course, well known to all of us. If you are practicing, you need to be only full-time practice. So any undertaking any other activity or business, you should always seek the permission of the institute, and you cannot get it unless it is the routine already generally permitted. So just to clarify this, permitted generally to be a director simpliciter in any company. You can also promote a company, but you should not be holding majority of stake in some cases. Even the members hold majority of the stake, or non-MD also they are continuing, and where if it is deemed to be an MD, you will land into problems. But otherwise, if you are just a promoter director or a simpliciter director or an independent director, you are permitted and you need not even inform the institute. But informing the institute is always a safe measure. If you are becoming a director in any other company, independent director with or without shares, etc., it is always safe to inform the institute. So, I mean, you can be a promoter also, but you should not become a whole-time director or a full-time director. So what are the permissions granted generally by the council by way of a resolution under regulation 190A is employment under CA in practice or a firm. That is, you can be an employee with any practicing CA firm. Private tutorships, as I said, taking coaching classes or tuitions is permitted. Of course, there is a restriction on this. Weekly 25 hours is restricted. And then acting as surveyor or loss assessor under the Insurance Act, it is permitted. No need to write for a specific permission. And full or part-time employment in business concerns, provided one doesn't hold substantial interest. That is, if the moment you hold a substantial interest, which means 20%, then you cannot be in employment in that particular company. And then full or part-time employment in non-business concerns. That is, charitable organizations like trusts and other things, where you can be a full-time employment also. And office of MD or whole-time director of the body corporate, provided relatives doesn't hold substantial interest. That is, when your relatives hold a substantial interest, you cannot be the whole-time director or MD. But even otherwise, the moment you designate yourself as an MD or a whole-time director in any other company, it would be, institute will not accept that as a general permission. So you need to be careful to substantiate that you don't spend any time on that. And interest in family business concerns. Suppose if you have inherited certain business from your ancestors, then also you need to write to the institute and say that it is devolved on you, and therefore you need to carry on like a HUF, etc. And say that the time spent on such business is very, very less. Then in such cases, the institute may give you. Then a CA in practice shall not engage in any other professional business except with the permission of the council. That is in general. The exceptions are that you can be a liquidator, a trustee of a charitable trust, an executor, or an administrator, arbitrator, receiver, advisor, or representative for costing, etc., appointed by the government, provided the appointment is not on a salary cum full-time basis. See, you can be appointed as an administrator, but if it is going to be on a full-time basis or on a salary, monthly salary, then you should not accept. Otherwise, all these things you can accept. And of course, under this clause, you can also become an MLA or MP or elected representative, so long as you are not a minister. If you are a minister, of course, government rules doesn't allow you to carry on any other profession, because you will be swearing in that you are full-time working for the government. So under that also, as long as you are not holding any position like a minister or other things, you can continue to be holding both your COP and the MLA or MP positions. So the director simpliciter means any director, any ordinary director, not MD or not WTD, required only to attend the board meetings and no remuneration except sitting fee. No specific permission is required for these simpliciter directors. Of course, independent directors also comes almost like this, because we don't need to inform the institute, but it is always safe if you wish to, you can inform it. And then promoter director, there is no bar to be a promoter director and a simpliciter director. And a member in practice in a HUF doing business. That is, if you are a member in practice and holding also a position in your HUF, which is doing some business, you should prove to the institute that you are not actively involved in the business of the HUF, or funds of the HUF can be invested in any business. Because here, the institute is giving a small leeway for those who are having these HUF things. But you should always prove that you don't spend so much of time which would affect your profession in general. In such cases, yes, you will be allowed. But in case if the institute is not convinced of your not spending much time, then they may say that you will be converted into part-time profession. So one has to be careful while holding any directorships in any other companies, Suppose if your family is having a major stake in a company where you are simply a director, not a whole-time director also, at times it may lead to some doubt that you are deemed to be a whole-time director. Therefore, try to avoid those conflicting situations by becoming directors there. Then I'm skipping again the other clauses and the second and third schedule parts of the first schedule. I'm moving on to part 4 of the first schedule, which talks of the other misconduct, because in the beginning we spoke of this other misconduct. See, there are 2 clauses in this other misconduct thing. One is if a member is held guilty for any civil or criminal court for an offense which is punishable with imprisonment for a term not exceeding 6 months. If a court has already convicted a member with imprisonment of not exceeding 6 months, automatically it will come under this part 4, and he will be held guilty of professional misconduct, other misconduct, sorry. So what about term exceeding 6 months? It will come under the second schedule. So even above 6 months also he will be held guilty, but less than, they have segregated it to this is lesser punishment area. So in a case where a member is held for any other offense by any civil or criminal court, then he will automatically deemed to be guilty under this clause. The second clause is very important. Nowadays, at least 25% of the total complaints will come under this clause. That is, in the opinion of the council, if a member brings disrepute to the profession or the institute as a result of his action, whether or not related to his professional work. So under this clause, all our actions are other actions, though nothing is concerned to your profession, but still if you have acted something in a derogatory manner which brings disrepute to the profession, then under this clause, a member is held guilty. This is a very wide clause, and many cases, for your information, some giving a press statements or some 2-3 instances where our members were found to be speaking to the TV channels under a sting operations, where they claimed during the course of this demonetization period, some members spoke to the press, conveying a meaning that it won't work, or they can convert the black money into white, etc. All those things have been booked under this clause. And even our own family disputes also, if a member behaved badly with the others in sharing of the properties or in any other manner, then all those things have been brought under this clause, and the members were held guilty. So therefore, it is very important for us not only to confine to the professional field, but even in our other aspects also, we should be careful not to get into any misconduct which would bring disrepute to the profession and institute. Then we move on to the second schedule, which talks of more with our work and quality of work and compliance with various standards, collection of evidences, all those things. This is a more serious schedule, and I may mention that under the first schedule, the maximum punishment that a member will get is 1 lakh monetary penalty and 5 years of 3 months of name removal, either both or one of them. But under the second schedule offences, if a person is held guilty, depending on the seriousness of the charges, a member name can be removed for lifetime, and also 5 lakhs of monetary penalty can be levied. So therefore, second schedule is more important and definitely very serious thing in nature. And we need to be very careful while dealing with the second schedule clauses also. In all, the second schedule has, in the first part, it has 10 clauses, and in the second part, it has 4 clauses, and the part 3, it has only 1 clause. So out of these 10 clauses, again, I picked up some 6 or 7 clauses for discussion today. The clause 3, which talks of permitting his name or the name of his firm to be used in connection with an estimate of earnings or contingent upon the future transactions in a manner which may lead to the belief that he vouches for the accuracy of the forecast. That is the projected financial statements, certification of projected financial statements. To directly come to the point, we are not expected to just certify the projected financial statements of any entity without appropriate wording and without following the concerned SAE, that is the Standard on Assurance Engagement 3400, which gives us even the format of a report where you have to say that the information has been furnished by the client and you have only evaluated the information and prepared the projections, and you are not certifying all those things. There is a big format under this, but invariably, as we have come across many cases, the auditor simply signs like a the notary type of thing. He will put his rubber stamp without any marks or writing on the financial statements. In a very recent case, we found that one chartered accountant certified for about 6 or 7 borrowers in some kind of a arrangement with the banker where the manager has referred all those people to him, and he went on signing on all the projected financial statements. And ultimately, all those advances were proved to be NPAs and fraudulently obtained. And the poor man, this member was caught for his negligence in supporting or in signing such financial statements. So whenever you have to sign a projected financial statements, take care to say that either you have only prepared the financial statements as per the information and assumptions whatever is given by the client, and you are not certifying anything the true unfairness or the validity of the same or to achieve those figures, etc. It's always safe. You should write that the above statement, I only compiled the above statement as per the information and things provided by the management, and I am not responsible for anything. But this kind of statement, no banker would agree for this. But there is no way you can say that I vouch for the true and correctness of these things. So therefore, either you follow the format given in the SAE 3400, which definitely protects you, and also in return, as a documentary evidence from the client, you must take all the assumptions and information given by the client to you for preparing these things. If you don't collect anything, then again you will be failing to produce any evidence, appropriate audit evidence that you have collected for preparing the statement. And in the case of public issue companies where disclosures in prospectuses also, you are aware, the company discloses the next 5 years projections, etc., where we will be signing. There is a guidance note given by our institute, and the wordings, etc., are all there. There, the merchant bankers also will be there, so they will protect you to some extent by giving the appropriate formats, etc. But these projections of small borrowers or borrowers giving to the banks is a very common feature noted in many of the places, particularly the mofussil towns, where the banker would insist that it has to be by a CA, duly signed by CA. So you need to be very careful to follow the format given in the SAE 3400 to enclose. Otherwise, you just say that you have compiled only that information as per the given information by the client. If not, we will be landing in trouble. And I have come across many cases where the members were held guilty for not obtaining appropriate audit evidences and signing it without writing anything in the as a matter of report or a certificate. So those things have to be avoided strictly. Then clause 4, expressing an opinion on financial statements of any business or enterprise in which he, his firm, or a partner in his firm has a substantial interest. That is, whenever you have you or your partner or your firm has a substantial interest in any other entity, you are not supposed to act as an auditor or sign any statements of that entity. What is meant by substantial interest? It is, our institute also said that 20% of voting power or shareholding. That is, if you hold 20%, in fact, this definition comes from the Companies Act, where 20% of voting power or shareholding is called as a substantial interest. So if you hold 20%, you or your partners or your firm or your relatives hold 20% of shareholding, then you cannot be the auditor of the said firm. Of course, it is, we'll see it in the next slide. And these financial statements includes both the reports and certificates. You can't say that only it is applicable for the audit or statutory audit or tax audit, but you can always issue, expenditure or income certificates, etc. No, the financial statements cover both reports as well as the certificates, and so therefore you cannot issue any certificate also if you are coming across, in this limit of 20%. Of course, the council has decided not to permit a CA employee to certify the financial statements of his employer company or a company under the same management, even though he holds a COP. That is, a part-time practitioner may hold a COP and working for a company as a consultant or as an employment also. But in such cases, he cannot certify the financial statements of that company. And a CA again cannot accept the auditorship of a college where he is working in the same college on part-time basis also. Suppose if you are teaching in a college on a part-time basis, where you only go and take that weekly 25 hours permitted and holding COP for a full-time, then you cannot accept the auditorship of that college. And the accept the auditorship of a trust where his partner is a trustee or employee of the said trust. Suppose if you are you or your partner is a trustee in a charitable trust, and you cannot accept the audit of the said trust. So the requirements of this clause are applicable to all attest functions, because you cannot do any certificate or audit report, etc. And where the member is a director, officer, or an employee in a company, Section 143(3)(b) of the Companies Act prohibits from auditing such company irrespective of holding substantial interest. This point I want to make it clear that in the previous paragraph, which was there allowing you to do the audit in a company where you hold less than 20%, but because of this Companies Act prohibition, you cannot act as the auditor of the company where you hold even one share in that company. So as far as the Companies Act units or companies coming under the Companies Act is concerned, this rule would take care. But in the case of other entities which are not registered or incorporated under the Companies Act, the 20% clause would apply for a partnership firm, etc. But even on a safe side, it is always safe not to do any audit in a company or in a firm where you hold some business interest, or even not even 20%, even anything, so that you will be out of those probable complaints, etc. And the same continuation, a director simpliciter cannot be the auditor of that company, because earlier we said a director CA in practice can be a director simpliciter, but he cannot be the auditor of the same company, because Companies Act itself prohibits under 141(3)(d), C, all these things, 3F, all these provisions of the Companies Act acts, and even though some of them are not prohibited under our code of ethics, but because of the Companies Act provisions, he cannot accept if he has a loan of 1,000 rupees, or a member from being audited if he is a partner or an employment and officer of the company, and whose relative is in the employment of the KMP. Now the KMP also, if your brother is a CFO or anything, you cannot be the auditor of the said company, and even your firm cannot be the auditor of that company. So you need to comply with both Companies Act provisions also here. And relative for this purpose would refer to the definition mentioned in AS 18, related parties. So we need to follow the definition of relative there. This is not to write certain activities which I picked up from our code of ethics. Code of ethics prohibits some of the actions from the auditor to do to the client where he is working for that. He is the auditor of that client. That is, he should not write the books. Of course, this is a very old rule known to all of us. And he should not be the statutory auditor. It should not be the internal auditor also, because in some cases we have come across, while the consulting firm of the CA firm was the internal auditor, the main firm was the statutory auditor, and there was some internal correspondence of mixing both the things. So avoid as much as possible not to even make others to understand that you are doing both the statutory audit and internal auditor, and of course under a different names within the network firms. and internal auditor not to be the tax auditor under IT Act or GST Act. This is a council brought guideline where if you are doing the internal auditor for an entity, you should not do the tax audit under IT Act or under GST Act, because internal auditor is supposed to be a kind of a management supporting agency, whereas the tax auditor is supposed to have independence. Therefore, the institute in its wisdom said that internal auditor should not undertake the tax audit. But I know in some of the banks, they insist that the branch concurrent auditor to sign the quarterly financial statements, which is not covered under the quarterly review. But there, in fact, I have taken up the matter with one of the bank, and I strongly protested that we will not sign even for the arithmetical accuracy. But still, some banks are insisting the concurrent auditors to just certify the quarterly statements for inclusion in the their consolidated bank balance sheets. So technically, you should not be signing even the arithmetical accuracy of that balance sheets of the branch where you are the concurrent auditor. Then 2 years cooling off period after completion of tenure as a director. That is, if you are working as a director, independent director in a company, unless 2 years is completed, you cannot accept the audit of that company. So you need to be careful. Members to satisfy whether appointment is as per the statute. And sometimes, in some of the companies in their memorandum articles, they mention that, the statutory auditor should possess certain qualities, etc. Or sometimes the statutory, the concerned act or the administrative ministry gives certain directions. So you need to ensure that the appointment is meeting the requirements, and the regulatory requirements and requirements of trust deed articles, etc., have to be complied before accepting the audit. And then we come to a very important 4 clauses, 5, 6, 7, 8, 9. These 5 clauses are very important, where they deal with our reporting requirements of material facts and material misstatements, etc. So a member will be held guilty if he fails to disclose a material fact known to him, which is not disclosed in a financial statement, but disclosure of which is necessary in making such statement where he is concerned with that financial statement in a professional capacity. So that is this clause talks of if you fail to disclose a material fact which is apparently known to you, but not disclosure makes the statement loses its value. So therefore, disclosure of which is necessary has to be disclosed. So this covers a lot of things, and of course this talks a material fact. So the materiality, you need to again refer it to standard on auditing, SA 320 materiality, where it deals with the situations on what is material and what is not a material item. So misstatements, including omissions, are expected to be material if they individually or in aggregate expected to influence the economic decisions. So anything, suppose you have not provided for adequately for the bad debts in the financial statements, which you are aware that then non-provision of that would lead to that you are misconduct, grossly negligent. So therefore, it is always safe you record your reasons for not disclosing certain things in the financial statements in your own working papers, and how you have concluded that it doesn't have to be disclosed. If you don't capture that in your working papers, then there is every possibility that the regulator or the complainant will say that you have joined hands in glove with the company, and therefore you did not disclose. Therefore, clause 5 of the second schedule part 1 would attract. And judgments about materiality are to be made in the light of surrounding circumstances, size, nature of misstatement, etc. Suppose in a case where the company's turnover is say 1,000 crores and non-providing of say 1 lakh or 2 lakhs as a bad debts, definitely it will not be material. But in a similar situation, if 10 crore or 20 crore debt is known to be bad and you have not provided for, that would amount to non-disclosure of material facts known to you. So therefore, again here the financial statements cover both the reports and certificates. So you have to ensure that even the certificates of income or expenditure or fixed assets from time to time will be giving. All those things would equally attract the provisions of all other clauses on par with the financial statements, whatever we are signing. Then clause 6, identical clause. Here it talks fails to report a material misstatement. There it was a, if you go back to that clause, it's a material fact known to you but not disclosed. Here it is a material misstatement which is known to you to appear in a financial statement, but with which he is concerned in the professional capacity. Suppose if you understand that there is a material misstatement, that again we take the same example of not making adequate provision for bad debts. Here, suppose if you have not made any provision for a bad debt, still you believe that there are bad debts, then it is a material misstatement which is known to you, and therefore you will be held guilty if you don't report such material misstatement. So observations, whatever we have talked of in clause 5 are equally applicable to this clause, because there it is a material fact, here it is a material misstatement. Otherwise, both are same and they stand on par in terms of seriousness. And the clause 7 is again, in today's context, at least 40-50% of the complaints come with this clause 7 of second schedule part 1, where a member will be held guilty if he does not exercise due diligence or is grossly negligent in the conduct of his professional duties. This is a very simple worded one-line clause, unlike all other clauses, but it is a very, very vital and very important and huge. Many number of cases are coming, getting attracted by this clause. Though it is a simply worded, very vital clause, which usually gets attracted whenever it is necessary to judge whether a member has honestly and reasonably discharged his duties. Even due diligence, he says, does not exercise due diligence. Suppose not writing to a client for confirmation of balance also falls under this clause. If you have not exercised a thorough check of your audit procedures and checkings, then it would come under hit this clause. And diligence encompasses the responsibility to act in accordance with the requirements of an assignment carefully and thoroughly. So the word diligence means that you act in accordance with the requirements of an assignment carefully and thoroughly. Suppose under the auditing standards, you are expected to follow certain procedures, SOPs, etc., to check the things and report. If you have not followed any of those procedures, then you are hitting this clause 7. So what constitutes a professional misconduct? Professional misconduct on the part of a technical professional cannot be found merely on finding of a bare non-performance of a duty or some default in performing it. So, what constitutes is a professional misconduct, negligent in the thing is that merely small, suppose you have not obtained a confirmation of balance from a bank for a small amount of balance, that cannot amount to professional misconduct. But what the various courts have said is misconduct implies failure to act honestly and reasonably, either according to the ordinary and natural standard or according to a particular profession. Suppose as per our auditing professional requirements, if you have failed to act honestly and reasonably, then you will be held guilty of misconduct, that is negligence. And though the term of fairly wide import, but generally speaking, it implies fairly serious cases of misconduct of gross negligence. Negligence per se would not amount to gross negligence. These are the earlier many courts said, but today there is no difference between the negligence and the gross negligence. Whenever there is a negligence comes before the disciplinary committee or board of discipline, that's all. They will say that clause 7 is attracted and they are holding the member guilty. So you can't say that this is not a gross negligence, this is only small negligence. So therefore, we need to be very careful, and particularly the gross negligence, some instances where failure to verify securities. Many of the senior members would be aware way back in 90s when the Harshad Mehta's case was noted. There were failures on the part of our members to verify the securities and failure to reconcile the bank balances. This is a classic case. Again, many of us are aware that how the bank balances were inflated in one of the famous cases about a decade back, and the failure to check cash balances, again, both bank and cash balances, issuing a false certificate regarding maintenance of records. This is again, in many of the cases, we confirm that the company has maintained so-and-so records, etc. But in real terms, suppose if the records are not there, then it becomes a gross negligence on the part of the member. So this class 7 is a very, very important, as I said, and any deficiency in the financial statements or in the audit report, the first class to be invoked in the complaint is class 7. So therefore, it covers any kind of deficiency in the audit procedures to be followed and confirmed. Therefore, we need to be extra careful to see that the audit is done as required with due diligence and duly complying with the auditing standards and reporting as required under the Companies Act. Because I am referring to Companies Act, because it is the one ministry or administrator which is getting the balance sheet, scrutinizing, etc. The partnership firms, definitely there is no such verification. The only department which verifies the thing is tax audits by the income tax department. Then clause 8 is again akin to the 5 and 7, but this is somewhat related to the auditing standards, where if a member fails to obtain sufficient information which is necessary for expression of an opinion, or its exceptions are sufficiently material to negate the expression of an opinion. That is, if the member fails to obtain sufficient information, there it was reporting, material misstatement or material facts, not reporting. Here it is obtaining sufficient information also. If you fail to obtain sufficient information which is necessary for expression of an opinion. Suppose if you are reporting on an entity where you failed to obtain sufficient appropriate information before giving a report, then this clause would come to play, and a member should not express an opinion before obtaining the required data and information. Suppose you are not provided with certain bank liabilities, etc., or confirmation of balances. That means you are not provided with the sufficient information, then you need to qualify or give an adverse opinion. But you cannot simply say that as per the books of account, this is the balance, and then close the matter. Suppose if the books are not matching with the real bankers' figures, you need to expressly state that you have not been provided with sufficient information. Then you will be saved. Otherwise, we will be in trouble. Then, if a member did not get full information for expression of an unmodified opinion, the auditor should clearly express his disclaimer. Please refer to SA 705, modifications to the opinion in the independent auditor's report. That is, SA 705 deals with the 3 situations where you can put certain things under matters of emphasis, which is again dealt in another standard. And under SA 705, definitely qualified opinion, adverse opinion, disclaimer, all these 3 situations are there. So if you are not getting sufficient information, then you need to choose one of those things depending on the pervasiveness or qualification nature, etc. Then what is then the clause 9 is fails to invite attention to any material departure from the generally accepted procedure of audit applicable to the circumstances. That is, if the auditor fails to invite attention to any material departure. This is also again almost similar to the previous class, where if the member did not obtain sufficient information, he cannot express an opinion. But here, if he fails to attention to any material departure from the generally accepted procedures of audit, that is, if you do not point out any material departures from the procedures of audit, then you will be held guilty. What is generally accepted audit procedure? Audit should be performed in accordance with generally accepted procedures of audit applicable to circumstances or entity. Suppose writing to the creditors, debtors for a third-party confirmation is a generally accepted procedure in India. Suppose if you are not writing to that, you need to report that I have not written to the parties. And it all depends on the facts and circumstances of each case. Guidance is available from ICAI by engagement and quality control standards, statements, guidance notes, etc. You have all this guidance from various institute publications, which talks of clearly what is the material departure and how much you can depart, and still manage to say that you have not deviated from the material departures. Then audit of listed companies, you should have a peer review certificate as required by SEBI. or stock exchanges, and firm registration number and membership numbers to be quoted in all reports. We are all familiar with this requirement. It is there for more than almost 10 years. And UDIN again is a new provision which came in about 2 years back. And still some of the members are not are not obtaining the UDINs for other reports. In fact, UDIN has to be obtained for all kinds of reports, including for concurrent audit reports and internal audit reports or certificates. So please make sure that you obtain UDIN not only for statutory auditors, but for all other attest functions, whatever you are issuing. And then the second schedule, part 2, again, there is one clause which is, I thought, important. Defalcates or embezzles monies received in his professional capacity. That is, whenever a member is found to defalcate or embezzle the money received in his professional capacity, he will be held guilty under this clause. Under this, I can say that there are some instances where some of our members have used the client's money for some time in their personal hands, and the clients have filed complaints, and those members were held guilty because we are not supposed to use their money. And if it is likely that the amount of the given by the client will be with you for some time, you are expected to put it in a separate bank account and keep it there. It's not the case that you cannot accept advance or for expenses from a client, but you should keep that money separately in a separate bank account if it is likely to take a reasonable time for spending that amount. And embezzlement, defalcates, of course, is like a fraud, but it is there in the class, so therefore I am bringing it to the notice of the members. And there is a second schedule, part 3, under which there is only one clause, that is the other misconduct, which is by any civil or criminal court, as I said in the earlier, with imprisonment for a term exceeding 6 months, he would come under this clause. So this is again an extreme case where a member who is imprisoned by a civil or criminal court beyond 6 months, again holding a membership, etc., which is rarely seen, but I thought I should bring it to the notice of the members. Now I'll just take you through some of the frequently noticed complaints, the evidences, where I will not be mentioning the names. You can see the names if you want in volume 3 of our Code of Ethics. Some of the cases are like this. In one popular case, the auditor stopped writing to seeking confirmation of balances from parties of the company, saying that they were not getting any responses, and therefore they dropped even writing to the parties for direct confirmation of balances, which the institute said nothing doing. Even if they don't respond, you cannot say that since they are not responding, I'll stop writing. So it is always safe that you should continue to write to the parties for a direct confirmation of balance, or make the company to write to them, asking them to directly confirm to the auditors. Share capital certificates. It has been the practice that whenever a banker is giving a loan to a company, they will also stipulate a condition that the loan will be released prorated to the share capital brought in. In the good olden days, we used to, all the companies used to keep a head called share application money for years together to accept and return whenever they want or whenever they don't want. So in at least 2 of the cases where I am aware, the chartered accountant who was not the statutory auditor was invited to certify during the middle of the year a certificate on share capital brought in by the client. And very sensitively, he verified the information. In one case, he took a ledger extract of the share application money on the date of signing the case and then kept it in his audit file. But subsequently towards the year end, the share application money was refunded by the company, and the balance sheet figure was much less than what was certified in the middle of the year. So the banker got annoyed and filed a complaint against the CA who is issued this certificate. And luckily, the member was having ledger extract on the date of his certificate, and he proved that he was correct on that day. The ledger balance was shown so much on the share application money. In another case where the borrower, the client, has brought in the entire amount by way of cash, the share capital. Unfortunately, the member did not keep any evidence, and the account became NPA, and later on it was proved to be a fraud case where the member was held guilty, and finally there is a problem in that. Thereafter, the member was held guilty for the failing to take evidence and show his sincerity. In similar way, fixed asset certificates. Again, the borrowers generally insist to the chartered accountant certificate for certifying what is the amount paid by the company in acquiring the fixed assets on a periodical basis. The members have been issuing the certificates, and later on, when the account became NPA or fraud was unearthed, the chartered accountant is booked for issuing certificates fraudulently or without verification. And the GST, ST refund certificates. This is again a case where we are all familiar. Just a few days back in Delhi, some 2 members were arrested in a fraud case of GST refunds. And this is coming almost regularly, almost monthly once from some part of the other. Or so the cases are found against our members for falsely certifying, or even sometimes they are alleging that the members are collusion with the managements in claiming fraud, false refunds. Then certificating the ROC forms. This is another big nuisance where many of our members were caught wrongly for certifying this, form DIR 12, etc. Innocently we certify because we believe the client with all integrity and everything, and we expect that he has been telling us the truth, and they produce the results. I mean, the kind of a board resolution, etc. In one case, I know where the member has just signed for resignation of one of the director. Apparently, it was a fraud case. The other side of the management has taken it for granted and shown him correctly, including they have given a copy of the minutes also. So he presumed that the board meeting was held and it was a genuine resignation. But ultimately, it was proved that no board meeting was held. The minutes were a fraud case, and ultimately the CA had to suffer. And the ministry also has taken it very seriously in all these cases. So please be careful while certifying particularly the digital signature certification forms with ROC. And in fact, in another case where a partnership deed was certified by a chartered accountant for the amendments, whenever there were amendments, those days client used to come and form 1 or 5 for intimation of changes in the partnership deed. We used to sign blindly. Only one partner used to come our office, and then we used to believe him and then sign it. So in the given case, I believe it was a family entity where 2 brothers were divided in terms of their understanding, etc. And one brother who used to come for the last 20 years came to the office, took the chartered accountant signature as a witness, and wherein their father, who passed away 4 years back, was still shown as a partner in that firm. So the other party, annoyed with this kind of a document, he filed a case before the Registrar of Firms, with the Registrar of CA Institute also. Though the Registrar of Firms simply annulled the document and did not initiate any action on the CA, but the Institute did not accept the same plea, saying that you are guilty of misconduct for signing the partnership deed without even applying your mind or without verifying the contents of the partnership deed. So do not sign any document as a witness. It's like we don't know what is true and correct. That is the environment in which we are living. So please do not sign such kind of partnership deeds. And the concurrent audit of banks, non-verification of gold and documents. Though concurrent audits, apparently many of our members take it very easy and send their juniors or paid assistants, etc. But whenever there is a fraud in a case where I know the bank management in collusion with the gold appraiser have done fraud by putting all these spurious gold in the gold bags. And after some time, the fraud came out. and the branch auditors, concurrent auditors, statutory auditors, all of them were booked for non-verification of old things. But luckily, their scope did not contain the verification of gold for its quality. So therefore, they are saved. Otherwise, the member would have become, ended up with paying a huge punishment for that. And moreover, concurrent audit, again, there were cases where there were serious audits which are happened in the audit branches where concurrent auditors are there. In one case known to me, the audit was given to me sometime, given to him sometimes in end of May or so. And in his hurry, he spent 3 months report he gave in a single stroke, saying the manager did not cooperate with him and said there are absolutely no things, sir, this thing, that thing, we are busy with audit, all those things. And finally, he certified that there are no fresh loans. But actually, there were a huge loans against own deposits of the bank where a fraud has taken place. And ultimately, the very senior member, he lost his membership for nearly 6 months because he was proved to be, he stated in his report that no fresh loans were sanctioned. But actually, there was a loans were there. So all these material information happened in the concurrent audit covered branches. So one has to be very careful while doing the concurrent audits. And internal audits not done as per the given scope. In a big public sector company, 2 internal auditors were found to have not followed the scope given by the management, and which ultimately suffered some losses because of some management actions. But the problem came on to the auditors because you have not verified the scope, the audit as per the information scope given by us. Therefore, why you should not be held misconduct. So he was held guilty of misconduct. Then related party transactions to be delayed, to be reported party-wise. In the beginning days of the standard announced, people used to group them and key management personnel, remuneration to key management personnel, or payments to so and so, etc. under the groups. But now the requirement, the institute has subsequently clarified, so it has to be given party-wise. So failure to disclose party-wise related party transactions would amount to misconduct. So people have to be careful. On this case, one very well-known Indian firm had to reach up to the appellate authority because they were under the strong impression that before issuing that clarification, there was no requirement to give party-wise details. So they have not given it, but the disciplinary committee held that you have to give. So, but luckily the circular which was issued at a later date came to their rescue, and they escaped the punishment from the not disclosing that. And issuing of revised audit reports. There are a few cases where some companies, in a particular case, one company, it's a listed company, issued its financial statements duly audited by the auditor as early as in April of a particular year. Then after 4 or 5 months, sometime in September, they wanted to revise their accounts, and they have the auditor has withdrawn his earlier report and issued a fresh report. But there is a specific standard what needs to be followed in all such cases, that is SA 560 subsequent events, which the member has not followed meticulously. He has to do a lot of exercise. He has to write to the management what is the triggering point and what are the additional evidence he collected in certifying the fresh balance sheet, etc. In the particular given case where I was referring to, the profit in the first balance sheet was something, some crores, and in the subsequent balance sheet, the loss was almost 3 times more than what they have declared the profit. So in all those cases, the member did not follow the standard. So therefore, he was grossly held negligible, and the punishment was very severe because it is a listed company and the auditor cannot be so casual dealing with 2 reports without even collecting any evidence. So whenever such situation arises, please see that SA 560 is meticulously followed. You will be definitely safeguarded if you follow and collect the documentation as required under SA 230. Then relying on the experts' work reports we need to be very careful, because you cannot simply say that I have relied on the valuation professional's work and accepted the valuation given by him while certifying the financial statements. Though you are not expected to do it at a greater length, but definitely you need to do some prima facie checks whether the valuation report is meeting the requirements of valuation standards, etc. Some broad checks you need to exercise. Otherwise, the valuation, if you simply accept the valuation expert or some other expert, actuarial valuation expert, etc., and then it may land you in trouble for not making minimum efforts in understanding the experts' advice. And then I have also come across cases where in issuing the CARO or format of the audit report or IFC, etc., many of the, at least the smaller places, the auditors are not familiar with what needs to be given for a given company. Whether it is a small company which enjoys exemption from CARO or IFC, etc., or whether it is a medium company or other companies, etc. So in one case where we found the member has given CARO some old format, though it was withdrawn long time back. So he was under the belief that the old format is still going on. So like that, there are some people. Last year I have seen a member furnishing Schedule 6 requirements in the current Schedule 3 requirements. So all these things are definitely putting our members in a black spot. So you need to be very careful on what format has to be given. See, for example, key audit matters, you have to give it for listed companies. It is not required to be given for other areas. Like that, CARO has to be given for a particular size of the companies. IFC also has to be given. So you need to see whether what is 143 requires for that particular company, whether it is a small company or other company. So all these things are, there are a number of cases where, for giving wrong reports, etc., have been, complaints have come against the members. Then a type of modification in the audit reports. As I said, in a very popular case where the auditor has gone, making them, giving a kind of a disclaimer against the treatment given by the company, but the regulators pointed out that you have traveled with the management in not giving a pervasive, complete adverse opinion. So therefore, we need to understand what are the various qualifications that are available. Our SA 705 has three different qualifications. That is, one is a qualified opinion, where misstatements are material but not pervasive. That is, if the misstatement is material, then you need to definitely issue a qualified opinion. And if it is an adverse opinion, where misstatements are material and pervasive, if both are there, we have to give an adverse opinion, completely giving adverse opinion. And the third thing is disclaimer of opinion. If you are unable to obtain sufficient appropriate audit evidence on which to base the opinion and the possible effects of the financial statements of undetected misstatements are material and pervasive, you have to give disclaimer. You cannot simply, though the management may disclose certain material things in the notes, if they are likely to affect your material misstatement or pervasiveness, then we need to definitely make them a qualified opinion or adverse or disclaimer. We cannot simply bring it to the notice under the UOM paragraphs. So in all these cases, one has to be extra careful in correctly identifying under which bracket of opinion it falls, the misstatements falls. And then not able to collect and retain appropriate audit evidence. SA 230, audit documentation is a very, very important standard. And it has set some timelines also for collecting the documentation and close the audit file within, I think, 60 days from the conclusion of the audit. The auditor has to compile his audit file and keep it with him. And now even NAFRA also is seriously contemplating to examine these audit files. They are, whatever cases they are selecting, they are calling for the audit files. So those who are doing the reasonably fairly big size audits have to be very careful in collecting the documentation, because ultimately the documentation alone comes to prove our innocence and our integrity with reference to the job. Otherwise, we will be into deep trouble. We cannot, because in most of the cases, what we see in the disciplinary committee or in the appellate authority is that the members are not having the adequate and appropriate evidence to demonstrate that they have done the job legibly and with the due diligence. So if you have the evidence, then definitely the agency has to believe that you have carried out the audit. So the failure to keep the audit is becoming, evidence is becoming a big problem. So though we spend a little time after the audit, it is very important to take the appropriate management representation letters and evidences and keep it in your file. Now everything is in digital form. You have to have, there is no other shortcut for this. Then presentation of details in financial statements, applicability of other acts and information. As I was telling you, those companies which are registered under the Companies Act but carrying on the business of banking, they are all registered with the Banking Regulation Act also. So the primary act for them for presentation of financial statements will be the Banking Regulation Act. In one case where I have seen the company is incorporated under the Companies Act, but carrying on the business of banking, duly registered with under Banking Regulation Act. So the Banking Regulation Act says that apart from providing all the information as required under the BR Act, the company shall also provide other information under which it is registered, so long as it is not inconsistent with the BR Act information. So the company in its financial statements has clearly stated that the company is complying with the requirements of Companies Act, accounting standards as issued under the Companies Act, and the BR Act requirements. But when it came back to the presentation of the balance sheet and the financial statements, we found that the company was not furnishing a lot of information which is required under Schedule 3 of the Companies Act, which is not inconsistent with the BR Act information. Because BR Act information is relatively small and less cumbersome compared to our Companies Act. So they have conveniently ignored the Companies Act disclosures. But in their notes, they have clearly stated that they have complied with Schedule 3 of the Companies Act also. And we have to see how the regulator will look at such deviations. So it is always safe for the members to, whenever they have to furnish or comply with the requirements of more than one act, to be careful in complying as much as possible. And this is applicable for almost all banks, like which are registered under the Companies Act or which are registered under the Cooperative Societies Act or RRB Act, etc. For all of them, Banking Regulation Act would apply, and the Parent Act also would apply. And another area where some complaints are coming is accounting of mergers, demergers, compromises, and arrangements passed by NCLT under the Companies Act. In some cases where I have seen it is again primary duty of the company to disclose all the facts of the scheme, etc. Somewhere some mischiefs are happening where the adequate details are not disclosed. So the members have to be very careful, because the first hand is coming on us, because we are the signatory to the financial statements. Only the secondary level management, the regulators are going against the management. At the first level, they are looking at the chartered accountants for the issues. Wherever there is a mistake, they are holding us responsible. And keeping the client's money, as I said, we are expected to keep the client's money whenever you hold it for some time, because in the earlier days, they used to give us for incorporation, etc. But now nothing is there, everything is online. But in one particular case, of course, again, it is about 15-20 years old case, where when I was in the DC, the case came up before us. One chartered accountant was handling the tax file of a retired pensioner who had some capital gains in that particular year. And the chartered accountant sincerely calculated the tax and told that gentleman X amount of capital gain and the tax amount. The client transferred the amount to the auditor's account in those days, and the auditor did not pay the full amount. He retained something, and in fact, I feel very sad to say, he created a fake challan for the total amount and gave the client that challan as if he has paid the full amount. but the client was intelligent enough to understand the ingenuineness or fakeness in that challan. He went to the bank and then he found that the amount was remitted is something substantially lower than what is stated in that challan. So he pulled him to the institute and he made a criminal case, again cheating case, all those things. Apart from all of that, he also filed a case before the institute. The chartered accountant made good all the money together with the interest he paid and everything. And finally, when it came to before the institute, we held him guilty and punished him with whatever appropriate punishment. So in that particular case, we tried to understand why the CA should resort to all these kind of things. He tried to explain in various manner that he wanted to save the client some money, but the basic fact that creating a fake challan came heavily against him, and we could not accept whatever he submitted in support of his things. In the similar way, there were a few other cases where some chartered accountants were involved in not paying the tax amounts given by their clients for sometimes years together. Sometimes they got into disputes, all those things. I think we should avoid those things. And now, of course, mostly it is all through e-banking. So you generate the challan and send it to him and he will pay. But even let us not take even a remote chance of his giving money to us and we paying to the government, etc. And in a few other cases where some of the chartered accountants have joined hands with the clients in their business as a partner, either in the name of his wife or in the name of his brother or some other things, and then got into litigations, disputes, and a lot of cases have come in this background also. But this is again an avoidable situation because you be a professional, don't get into the business of your client. So that is a very dangerous situation, and eventually, many of them reached up to High Court, Supreme Court also, some of the litigations, and it is again an area where whenever you have such situations, you need to be extra careful. And the societies and trust audits, again, it's a very, not a very regulated environment, but there again, I have come across at least about half a dozen cases where the societies have moved from one auditor to another auditor, and innocently the new auditor has not taken the previous auditor's certification and landed in trouble. And even sometimes withdrawal of the complaint by the complainant is not permitted by the institute, though the act and the rules say that yes, a complaint filed by a person can be withdrawn anytime during the currency of that complaint, but not all the times the institute permits withdrawal, because when a major non-compliance or misconduct is seen on the face of the complaint, so the institute understands that it is a methodology adopted by the complainant to get his matter settled by filing the complaint. So therefore, the institute also understands the seriousness of the matter and not allowing the things. So all these things are very clear, and there are cases are increasing day by day. And one more point I would like to tell the members that there is no requirement of locus standi for filing a complaint against a particular member. If you are even not a shareholder or not in any way concerned, you can still file a complaint against a member for his professional misconduct. So therefore, it is not like a civil or other criminal cases where you should have some, locus standi. But here, anybody can file, and it is a very peculiar situation. And I can tell you that if given a complaint against a member, it will take any time 3 to 5 years. Even if it is dropped also, it might take minimum 3 years to 5 years. So all these periods, he will be on a very, very tense. I know how difficult it is to carry a complaint against us, because we are so much worried with the things, and not many professionals are also available to represent the disciplinary cases across the country. Because I've been seeing in the last, almost I was in the council from 2007 till date, 15 years, hardly 10 people are there in the country, I can say that, who have a fair knowledge of presenting these cases. So it will be very difficult for a member to defend his case before the disciplinary authorities. So it's all that we can do is follow the rules, regulations, and code of ethics in a very, very strict compliance mode, and ensure that nobody files a complaint against us. And prevention is better than cure. You should always remember and follow the rules. Otherwise, it will be very difficult, and we will be put to a lot of stress and unnecessary time spending on these matters. So with this, I stop it here. Any members, if you have any questions, maybe the organizers can address, or I will try to see in the question answer things. And
we have two questions, sir, actually.
Yeah.
With your permission, should I read out, sir?
Yeah, I am able to see this. How to communicate to the deceased previous auditor? See, if the deceased previous auditor has a firm and there are partners, you write to the firm of that entity. Suppose if the auditor was a sole proprietor or an individual, and then you can record in your your audit notes that since the member firm member is not there, there is no need to write to the previous auditor. But if it was a firm and the signing partner who signed the balance sheet died, you have to communicate with the firm. Then there is a second question. Can a statutory auditor of a non-listed company provide GST-related services to the same company, like filing of returns, etc.? See, now we have Section 144 of the Companies Act, which prohibits certain services by a chartered accountant to the same company where he is the statutory auditor. Any management services is prohibited. So Section 144 of the Companies Act. Under our Code of Ethics, there is no such bar, but Companies Act prohibits you from providing any management services. And I am sure the Institute also has addressed this matter on what is a management service. Management service is a service which the management it is akin to the services provided by the management. Suppose a mere preparation of and typing of a document and filing it in a quarterly return doesn't amount to management services. That is permitted. But if it is a serious management service like advising the company on GST or appealing or appeals there, then definitely it is not permitted. What if the client is not a company? If the client is not a company, definitely all these rules are not applicable. Whatever Companies Act rules will not apply to any other entity which is not incorporated under the Companies Act. So you can provide. But our institute, again, in Code of Ethics Volume 1, has explained certain things that you should not undertake. So please follow the Code of Ethics Volume 1, where what is that you can do and what is that you should not do has been clearly explained. Of course, there again, it is a public interest entities are barred from providing all kinds of services. So you can please look at the specific Code of Ethics points and then provide.
Yeah, Ravi. Yeah.
Since there are no other questions, so we will conclude this, sir. Sir, we really thanks to you for sparing your valuable time and sharing your first-hand information and.
We are exactly on the dot, Ravi Shankar. It is
2 hours of PowerPoint presentation. I really appreciate, sir. So patiently you
7:58. So we are on the dot. If any member has anything to say, they are most welcome.
That's what I asked. I think there are no other questions. They are only saying thanks.
No, there is one more question answer.
Just now.
While providing non-attested services, should we apply same verification of documents and details as we apply while providing attest services? Yes, definitely you have to, while providing services, non-attest services also is a service. You are committing something. So it is always better and follow the same due diligence or evidence collection process, and so that it will be safe for you. When you are providing even a consultancy service, and I should share this case with all of you. In one personal tax assessment of an individual, the auditor appeared and the order has come. After the assessment order came out, the assessee filed a complaint against the CA before the institute, saying that I never authorized this fellow to appear before the ITO. He appeared and gave some information and got a heavy demand against me. So he should be punished. So therefore, even though it is a non-attest function, I think he should have taken a, first of all, power of attorney, an authorization to present the case, all those things. Because he did not take, then he got into trouble. So finally, of course, luckily he got out of the issue. That is a different thing. But how the attitude of the clients is changing. So you should also be careful while taking the appointment letter. Now, most of the cases we don't have appointment letters, excepting under the Companies Act, where it is a mandatory for us to file that AOC form. Other tax audits, most of the cases we don't have. We don't take the appointment letters. And tomorrow, if some dispute comes, one partner goes on alleging that the auditor has no appointment, then where do we stand? So it is in our own interest that we should follow the same kind of documentation for the things. Then there is one, can a statutory auditor advise the client on how to write off certain advances given? You see, again, a statutory auditor giving an advice would depend on what kind of, in what mode he is giving. Orally, he may say, you write off this advance, etc. But if he gives it in writing, then it amounts to first management services. Secondly, it might amount that he is also bookkeeping the accounts of the company. So therefore, don't put anything in writing. If you want to put it in writing, put it in your management representation letter. See, you can always raise a query that why this advance is not written off, given the circumstances in which it is pending. But don't suggest on your own that you write off this, you don't write off this, all those things. Don't get in and keep it in your correspondence files. Then the next question is, can a statutory auditor issue a certificate on receivables to bank? Yes, I think most of the companies are submitting the quarterly returns, debtors, receivable or stock statements, etc. to the bankers for the cash credits they are enjoying. So that you can issue. Definitely, you need to obtain a UDIN, you verify the debtors, and you keep evidence of the debtors in your evidence file. Because now under CARO, you have to again confirm that the quarterly statements filed by the company are in accordance with the books of account. Suppose if something goes wrong at a later date, then you should not find yourself in a difficult situation to answer that. So therefore, you can issue. And but you have to keep evidence of what you are certifying. Then CAs have to follow many responsibilities, how to claim rights also in carrying on profession. I think so long Mr. Hanumanlu is the querist, so long as you follow the responsibility, you will automatically get the right also. So now that is why Companies Act provides you 5 years of appointment undisturbed. And if the company has to remove you, they have to follow a huge procedure. So therefore, your responsibility gets you the rights also. So please discharge your responsibility carefully so that you will also get your protection. Posting in WhatsApp status, file your income tax return, contact CA, any misconduct in this. I'm sorry, I'm not able to give on this social this thing because our code of ethics is yet to rise to the occasion to say what is circulated in WhatsApp, whether it is a misconduct or not. So I don't want to say yes or no for this, but definitely as a senior CA, I would advise you not to resort to sending that kind of messages. So let us not get into that kind of a situation and get even by way of a notice. I can tell you precisely that during the demonetization period, some members have, gave statements on how to convert the black money into white or old notes into new notes, etc., without paying any tax. For all that, they are paying a huge price. It was a sting operation, but it's all coming heavily against them. So let's not get into any avoidable situation. Then what are the checks to be done in case the client write off certain amounts as bad debts? See, you verify the audit as per your audit procedures. You check whether that bad debts were actually accounted as income in the year in which it was invoice raised, because there could be a situation where he might be writing off some advances also. First of all, it has to be ensured that it was a receivable, and see whether any reasonable efforts have been put in to recover the amount. And so all those steps you please follow, and then accept for the take a management representation letter and deal with that. Suppose if you are not agreeable, then you must record the reason why you are not agreeing. If you are agreeing also, you should collect enough evidences so that it is there is no mistake in that. Then what are the checks to be done in case the client write off certain amounts as bad debts? This in case the amounts are huge. That's what, if the amounts are huge or material enough, let us understand that it is a material amount. So if it is a material, you have to definitely look into when the original invoice was raised and why the debt has become bad, and what were the efforts by the company to recover that amount, whether any court cases have been filed, and so on. So you need to convince yourself that the action of the management is acceptable. Then what should be the time lag within which the amounts can be written off as bad debts? Again, it depends on the nature of bad debt that you are writing off. Because see, in a particular case, in the same year, it might be written off as a bad debt. Suppose in the beginning of the year, the party raised an invoice and they accounted it as income. Towards the end of the year, the other client became an MP, insolvent or shut down, etc. So it might be written off in the same year. So therefore, there is no specific rule that it has to be a certain time limit has to be kept, or it might become bad in the next year because of again insolvency of the client or the party, or non-paying or legal litigation, or sometimes even the material amount also may be very immaterial, etc. You can ignore that. Do you want someone is asking? If RBI is one second, the last question. If RBI's approval is not taken on overdue export receivables, does a statutory auditor have to report in his her report? See, if it is a material amount where it is likely to affect the quality of your receivables, I think it is better the auditor brings it out at least as a matter of emphasis in his audit report, by duly disclosing it in the notes on accounts. The management may disclose that the RBI's approval is yet to come for even write-off or export receivables. Suppose if you wish to receive, write off an export receivable, you have to need the authorized banker's approval. If it has not come, but the management is writing off, I think it can be mentioned in the notes and draw attention to the emphasis of matters. Last question, I think, can the amount be written off as bad debt only in the debtors becomes insolvent? Not necessary. Suppose if the debt becomes completely non-recoverable despite your other party being solvent, still you can write off. There is no need to that the debtor has to become IP. I've only given an example that if the debtor becomes an IP in the same year, you have to still write off. No, it's all, case to case, you have to assess what is exactly the situation and how you should come out of the, report it. Is court case compulsory? Definitely not required. Even in the management, in its own wisdom, may not prefer all cases to the court, because court cases also are very expensive and they may have to pay the court fee, etc. So there is no requirement that all cases, bad debts have to be through court cases, etc. It's a management decision whether recoverable or not, and the auditor, if he agrees, it will go smoothly. Otherwise, he can raise his point. And if the amounts are so material and the management is writing off, then you may have to report it the qualified opinion that the management has written off X amount of debtors without pursuing with the fee for collection. So therefore, to that extent, the profits are low, something like that. You have to make out a qualification if you are not convinced with the management's decision. So I think we'll close.
Close, sir. 10 minutes. Once again, thank you very much, sir, for your excellent and
my
interactive session.
brother, Shankar, always available to the members.
We know, sir. We know, sir. It's only a formality that we should sell. Otherwise, you are always available to us individually and in personal capacity. I thank Vice Chairman Satish Kumar Mailavarapu and all attendees. And before we close, Santosh, can you share the virtual memento to sir as a token of respect? Santosh.
I didn't, Ravi.
Sir, please.
Oh, thank you.
Please accept our.
For giving me the nice virtual.
Thank you, sir.
Thank you, Javi, sir.
Satish Garu, any closing remarks?
Tomorrow in my mailbox.
Tomorrow?
Tomorrow I'll get it by mail.
Yes, sir.
But don't send me any physical plaques or mementos, because last year I got one or two which I feel not required. This is sufficient. I'll keep it on my table.
No, as a happiness from our branch sides of that, sir. Sir, thank you, sir, for your wonderful and power-packed 2 hours presentation. We really appreciate your patience and dedication towards our professional members. Thank you, sir. Once again, what do you say? We really thank you for your presence and address. I hope and wish all the members will follow all these aspects in our regular practice and with due diligence and what do you say, discharging their functions. We really thank you all the members for your kind participation. With this, we are winding up this session and we'll be catching up very shortly with